This is the most controversial pick of the journey so far. British American Tobacco, 5.78% dividend yield, 25 years of consecutive dividend increases, and a share price that has lost 10% of its value in the last 12 months. Most modern investors will not touch tobacco with a barge pole. I just bought 4 shares. But here is the part most people miss. Even after that 10% drop, the dividend has never been cut. Not during the pandemic, not during the regulatory crackdowns, not during the rise of vaping or the wave of ESG-driven institutional selling. So either the market knows something the income investors do not, or the market is wrong, and this is one of the best yields in the FTSE 100 hiding in plain sight. Quick one before we go any further. This is not investment advice. I am documenting my own investing journey. Always do your own research before putting money into the stock market. Tobacco stocks come with real risks that we are about to walk through, and they are not for everyone. Let me start with why this is genuinely controversial. Tobacco kills around 8 million people a year worldwide. Many investors, including some of the largest pension funds in the world, will not own these stocks for ethical reasons. The ESG screening movement has driven institutional money out of the sector. Newer investors often will not even consider it. And I want to acknowledge that up front. If holding tobacco shares does not sit right with you, that is a perfectly reasonable position. This video is not about whether tobacco is good or bad. It is about what the actual numbers say for someone building a dividend portfolio. There are 5 real reasons people avoid British American tobacco, and they all deserve serious answers. First, cigarette volumes are declining around 5% every year in developed markets. People are quitting. Younger generations are not picking up the habit, so the core product is shrinking. Second, regulatory risk. Governments tax tobacco harder every year, ban menthol flavors, restrict advertising, and some countries are moving toward generation bans where anyone born after a certain year cannot legally buy cigarettes. Third, the lawsuits. British American Tobacco regularly faces multi-billion-pound legal claims, settlements, and government penalties that take real money off the bottom line. Fourth, ESG exclusion means a meaningful slice of buyers are permanently locked out of the stock. That puts a structural cap on the price. And fifth, the share price chart. British American Tobacco has gone effectively sideways for years. If you wanted capital growth, this was not the place. Before we get into why I am buying anyway, quick one. If you want to follow this entire journey from £200 a month to a real dividend income, subscribe. Every stock pick, every dividend payment, every reinvestment, all tracked in real time. There are no other channels following an actual UK dividend portfolio month by month from the very beginning. Now back to the case. Now here is the case for buying anyway, and it is stronger than the bear case wants you to think. Let us start with what you actually get. The current dividend yield is 5.78%, but the 5-year average yield on British American Tobacco is 7.57%, which means the current yield is actually below the historical average. That tells you something important. The share price is up from the lows, and the dividend has kept growing. People who bought at the lows are getting close to 9% on their cost. People buying today are getting 5.78%. Either way, that is well above what most savings accounts pay, well above the FTSE 100 average yield of around 3.5%, and paid quarterly rather than twice a year. Second, Dividend Aristocrat status. British American Tobacco has raised its dividend every single year for over 25 consecutive years. There are roughly 40 companies in the world that have done this, globally, not just in the UK. That puts British American Tobacco in extremely rare company. Through the dot-com crash, the financial crisis, the pandemic, and now the ESG selling wave, the dividend has never been cut. The cigarette volume decline has been priced in for decades, and yet the cash keeps coming. Third, dividend cover. The payout ratio is around 69%, which means for every pound of profit British American Tobacco makes, it pays out 69 pence to shareholders and keeps 31 pence in the business. Cover ratio of around 1.5 times. That is healthy. There is genuine room for the company to absorb a bad year without touching the dividend. Compare that to Legal & General, which I covered in episode 2, where the dividend cover is closer to 1. Tobacco is actually paying its dividend out of comfortable headroom, not pushing right against the limit. Fourth, the business is not standing still. British American Tobacco has spent billions developing what it calls new generation products. The Vuse vape brand, the Jello heated tobacco device, modern oral nicotine pouches under the Velo brand. These three categories together now account for around 15% of total revenue and growing. And these are not loss-making science projects. Vuse is the world's #1 vape brand by retail value. Glow is profitable across the heated tobacco category. The combined new generation products business now generates billions in annual revenue and is growing at double-digit rates. Importantly, these products carry higher margins than traditional cigarettes. So while the cigarette base is shrinking 5% a year, the new products are growing fast enough to mostly offset it on revenue and improving the overall profit mix at the same time. That is the transition the market is skeptical about. But the actual cash flow numbers say the strategy is working. And fifth, the price is reasonable. The price to earnings ratio sits at around 12. For comparison, the FTSE 100 average is closer to 15. The S&P 500 is closer to 25. So British American Tobacco is trading at a meaningful discount to the broader market. Combined with the high yield, it is one of the cheapest income stocks of its size on the London Stock Exchange. So here is what I actually did. I bought 4 shares of British American Tobacco at around £42.70. That is £170.80 going into the position. The forward dividend rate is £2.45 per share per year. So those 4 shares will pay me roughly £9.80 in dividends over the next 12 months, split into 4 quarterly payments. The first one should land sometime in August. Combined with my legal and general and Aviva positions, my forward dividend run rate is now around £26 a year on £370 invested. That is a blended yield of just over 7%. And I want to be honest about why I am picking British American Tobacco specifically over other UK tobacco names, like Imperial brands. British American Tobacco has the bigger international footprint, the more aggressive new generation products investment, and the longer Aristocrat track record. Imperial has a slightly higher yield right now, but a less defensive long-term position. For a buy and hold forever dividend strategy, the Aristocrat status of British American Tobacco wins. The plan from here is simple. Hold this position. Reinvest every single quarterly dividend automatically. Add to it as new monthly money comes in over the next several years. The thesis is that whatever happens to cigarette volumes, the new generation products keep growing, the dividend keeps getting paid, and the reinvestment compounding does the heavy lifting over 20 or 30 years. If British American Tobacco ever cuts the dividend, the thesis breaks, and I sell. Until then, every quarterly payment buys more shares, which pay more dividends, which buy more shares. Let me put some real numbers on what that compounding actually does. If British American Tobacco grows the dividend at just 3% a year going forward, and I reinvest every quarterly payment, those 4 shares I just bought become roughly 7 shares in 10 years, 11 shares in 20 years, around 16 shares in 30 years, paying me a forward dividend of close to £70 a year from this single position alone. That is at 3% dividend growth, which is below the company's actual historical rate. If the dividend keeps growing closer to its historical pace, the numbers compound much faster. And the risk frame I am genuinely comfortable with is this. The thing that would make me sell is a dividend cut, not a slowdown, not a bad quarter, not headlines about a new regulatory threat. Tobacco stocks live with regulatory and ESG headlines every week. The actual signal is the cash payment. If British American Tobacco breaks its 25-year streak and cuts the dividend, the entire thesis is wrong and I exit. Until then, the noise is noise. And one thing worth flagging for the income investors watching, there are roughly 40 dividend aristocrats globally, companies that have raised their dividend every year for 25 years or more without exception. Most of them are in the United States. Coca-Cola, Procter & Gamble, Johnson & Johnson. The UK has very few stocks that meet the strict aristocrat standard. British American Tobacco is one of the rare British names on that list, so if you want exposure to the rarest kind of dividend reliability and you specifically want it inside a UK ISA where the dividends are tax-free, the choice set is genuinely small. That scarcity is part of why I'm comfortable with this position despite all the noise. And to be specific about what would actually make me change my mind. 3 things. 1. A dividend cut or freeze. The Aristocrat streak is the entire reason I'm here. The day it breaks, the thesis is broken. 2. New generation products growth stalling. If the vapes and heated tobacco roll over and start declining alongside cigarettes, the long-term cash flow story breaks. 3. A regulatory event that genuinely caps the business globally. Something more aggressive than any of the existing patchwork of country-level restrictions. None of those 3 are happening today. All of them are watchable, and if any of them does happen, I'm out the same week. That is my case for British American Tobacco. 5.78% yield, 25 years of dividend growth, quarterly payments, healthy cover, a new generation products business that is genuinely working, and a share price that has not really gone anywhere for years, which is exactly what allows the dividend to compound. If you want to follow the rest of this journey, subscribe. Next month I add another £200 to the portfolio, and I'm already looking at a stock you might find even more controversial than tobacco. Now, I want to hear from you. Would you ever own a tobacco stock for the dividend, or is it a hard no whatever the numbers say? Drop it in the comments. The answers genuinely shape what I cover next. Until next time, happy investing.